I'm Charlotte McLeod with investingnews.com, and here today with me are Keith Watson and Rob Crayfourd, co-fund managers of the uranium-focused Geiger Counter Fund. Thank you so much for being here. Great to have you both.
Thank you.
Thank you.
Really good to be speaking with you both today. And of course, our conversation is going to center on uranium. So I'm going to start with a fairly broad question here, just because it is our first time talking. Where do you see us in the uranium cycle currently?
I'll kick off with that one. When we talk about cycle, we talk about the balance in the supply and demand in the market. And I would say at the moment, investors really shouldn't be put off by some of the price volatility that we've perhaps seen lately. Perhaps some will also think that it's quite high. The fact is that we've had more than a decade bear market on the supply side, in which there are now really only a handful of mines that can actually supply uranium, and it's quite clear that we're moving into a deficit of some proportion, particularly given the signatories of COP28, which is targeting such a large increase in nuclear power capacity. That is only going to apply further pressure on the supply imbalance in the market. And the crucial fact is that for this sector in particular, unlike, say, fossil fuels, the value of uranium as part of the fuel that goes into electricity is a very small fraction. So we're probably talking at less than 8% at the moment, at around $80 per pound U3O8. Admittedly, that's slightly higher when we add on conversion and enrichment and fabrication. But still, in comparison to, say, fossil fuels, which, despite them having pulled back, are still some way above levels that we've seen pre-COVID, feeding through into power costs, which are twice the level of 2019 on average in most sort of established developed markets. And that, I think, just shows you the economic rationale for having nuclear power in the fuel mix, which is contributed to the COP28 signatory agreement. And I think the fact that nuclear is very much seen at the heart of a balanced power mix, and at the sort of its key advantage is that it doesn't produce carbon, if you just want to look at the carbon emissions as an environmental factor. But these factories are effectively power stations that are just a very good way of delivering baseload power for the very long term, very cost effectively. And that's just something which I think has arguably been skewed somewhat because of policy that's been perhaps overly favourable to renewables as they try and increase that mix in the fuel balance. But ultimately, we're at the very start of what we expect to be a longer term imbalance in supply versus strong demand, and therefore a very healthy price outlook for the sector.
All right. I think that gives us a nice setup for this interview, just letting us know where we are in the cycle. I want to go to a little bit more recent news that's timely. So the World Nuclear Symposium just wrapped up a couple of weeks ago, and I believe you both had a chance to attend events and meetings surrounding that. So curious to hear about any takeaways or sentiment thoughts that you had from the event.
A very good question. If I just start first there, Rob, I would say one of the most obvious anecdotes was that it was sold out to capacity. So there were a number of new investors that were clearly looking to learn about the sector, which has now come very much back into the electricity fold. And I think there's a lack of knowledge and understanding around it because no one's really paid any attention to it for 10 years. So that, I think, was one of the more interesting side notes of it. The other was that I think people are probably expecting utilities to re-enter the market for a typical seasonal purchasing, which takes place around this time of year, having had a bit of a hiatus. And one of the final points that might contribute to that was the fact that some of the more recent pullback in price in part may be a result of the fact that some of the larger suppliers of material have set contract prices with a $70 floor from which prices are escalated in the future. And utilities, perhaps in light of the sharp move up in prices, took a step back and just wanted to see how the market settled, because they may as well, and just see if they can get back into some more reasonable pricing or more opportunistic pricing, perhaps. That said, though, it's quite telling that one of the largest independent suppliers, Cameco, has largely sold out of material for the next 5 years. So it's going to be, a bit of an ask to perhaps come back to 70. But I think it raised the question as, if they're sold out, why were they setting prices at 70? And, the incremental supplier now is going to be looking at, I would have thought, higher prices than that. So those were some of the key messages that certainly I felt came from the conference and the meetings that we attended around it. I think Rob may don't have other points.
Yeah, I'd probably add a couple of bits. I mean, obviously we're kind of focused on investing in the uranium miners themselves. So, really we were quite focused, as were many others, in trying to kind of piece together why we've seen a weaker spot market, given all the positive headlines and positive news that otherwise you would think would be incrementally positive. So, we spoke to a number of traders, utilities, as well as the mining companies, and I guess kind of key takeaways and explanations there would have been, well, firstly, we've seen spot probably got a little bit extended ahead of the term price, so we've seen that come back more in line. So that's starting to justify a return of the carry trade, which means people will, or traders will start to buy on spot and deliver into term again. So that that helps kind of provide a bit of a floor to the spot market. But similarly, it's around utilities having been generally quite cautious given uncertainties, particularly around the Russian import ban and the waivers they're therefore receiving we've seen them awarded for up to 2 years. So I think a sort of general sort of caution there. So they kind of generally backed out of the market as they've waited to see some kind of resolution to that.
Okay, really good to get those takeaways from the event, especially on the utilities, which we know are a pretty opaque part of the uranium market. I was wondering, just taking a little bit of a step back on demand, there's many countries around the world that have made nuclear power commitments, clean energy commitments. What should investors be paying attention to kind of at that higher level of demand?
I would say it's just watching for an improvement in the regulatory process, which has been something that's perhaps been a bit of an impediment over the last 10 years. We've had such a sea change in sentiment, both from a public standpoint and from a government policy standpoint, that I think the helpful aspect will be that we'll get some easier policy implementation as a result of it. We've got probably easier access to finance, and that will come in the forms that will help lending into the larger, 1 gigawatt scale reactors. It will also perhaps lend itself towards standardization and perhaps, by the end of the decade or thereabouts, some take up of small modular reactors, which are ultimately aimed at reducing the upfront capital cost of developing nuclear power, which is the biggest single item on the cost of electricity subsequently produced, capex and rolled up interest. And I think those are some of the most important aspects to keep an eye on, because those will be the ones that will free up the ability to deliver these reactors in a timely fashion. I think it takes it's not just on reactors though, it's also through the entire fuel chain. So it's all good and well knowing that we have a supply deficit in uranium, but we need to have back-to-back conversion and enrichment capacity to avoid some of the bottlenecks that can occur in the supply chain itself. And I think that's going to be folded into the same policy environment that we'll see as a result.
Yeah, I'd add to that. I think one of the key things to watch here is that you've got, you've got very sort of different markets in the West and the East. So, we kind of simplify it as actually the utility demand side of the equation is kind of the easiest to understand, given given the WNA put out pretty clear data there on reactors being built, where they will be coming from, and what you can see is really the majority of growth is coming from Asia and primarily China. And if we look to the West, it's more about seeing reactor life extension. So, as you're seeing kind of that positive policy shift towards nuclear in the West, particularly as they're trying to meet carbon emissions, where this is the only form of zero carbon baseload power, you're seeing life extension. So that's a key driver as utilities then look to contract more into that. So really growth more about Asia, which is kind of interesting because that then kind of feeds through into the spot market on U3O8. And what we've seen is, China has bought nearly all the excess material over the last 5 to 6 years and have materially increased their reserves, whilst the West has really seen very little addition. So it's a very different market on a number of senses, and ultimately, the Chinese do ultimately seem to have kind of taken control of the supply chain.
Right. So I think that gives us quite a good idea of what's going on with demand. And if we shift over to supply, it seems like one of the dominant narratives, as I think has been mentioned already, is that the major uranium companies really aren't equipped right now to keep up with the demand that just keeps growing and growing. Meanwhile, we've got geopolitical developments like just recently Putin's comments that Russia may restrict uranium exports. So I'm curious on the supply side, what elements you're watching most closely?
I think it's a very easy answer. It's where is it going to come from in timely fashion? And I think in large part it's going to be from those projects that are most or furthest forward with regards to permitting. We look around geologically for good deposits that will be mines, not require much higher prices to necessarily be developed, though we do have some of that in the portfolio. And there aren't that many very good quality deposits out there to fill the void that's being projected at the moment. And, that's the ultimate point. Obviously, we've got tier one assets in the Athabasca, which are very much the sort of fulcrum of our portfolio positioning, in preference to some existing producers, perhaps in terms of position sizing. But they, the big incumbent producers as we stand do have some very good land packages on which they can provide some resource growth and development opportunity, but it will need to be delivered quite in timely fashion through a still quite stringent permitting process, particularly in Canada. And that's still one of the main factors that we have to consider. And of course, we look for good management teams that have got the skills set to deliver on that.
Yeah, I mean, I would add to that. I mean, it's very difficult to grow uranium production quickly. There's a number of reasons for that. So, many of the existing mines are fairly mature, so they just don't have that kind of mining flexibility to kind of increase production 10-20%. So, we simply don't see that. For bringing on new mines, there's generally quite a long permitting timeline. More so than if you're trying to bring on a gold mine or even a copper mine. Uranium projects have to go through even more stringent kind of environmental oversight and kind of approval. So that really kind of adds to a lag effect. And then more broadly as a snapshot where we are today, and it's just huge geopolitical uncertainty. We touched on it with the Russian import ban, but we've also had coups in Niger, so that's really restricted supply into Europe, where they used to where the majority of their exports used to go. And then obviously we had the Kazakh issues around sulfuric acid shortage, and the impacts they've had there around sort of export routes and the impacts that's had. So that's kind of left the market where particularly a number of utilities did think that material is going to be available. Clearly that's being pushed out now, and that's added to short-term pressures on supply.
And if we look at some of the bigger groups such as Cameco, to be fair to them, they have extended the cigar life by about 2 years of additional resources more recently, but they will need to continue to do that. And there's a good chance that that incremental later stage production will be higher cost than current production, and that's only going to put upward price pressure into the market. And that's the whole production flat.
Right. And I think, okay, so as we're getting over into the company side, I wanted to we've talked about how you manage together the Geiger Counter Fund. So I wondered if we could talk about constituents of the fund, goals of the fund, just so the audience has an idea of what the intentions are there.
Yeah, I'm happy to start on that. Yeah, like we, primarily when you're looking at a mining company, you kind of want to focus on jurisdiction, and then you want to find the best, best asset quality, and then management. And I feel like in uranium, we're quite fortunate in that you have the best assets in the world geologically. And I'm a geologist by education, but you have the best assets geologically. We also have it in a true tier 1 jurisdiction in Canada around the Athabasca Basin assets. This also doubly ties in really well into where do we see a looming shortfall by, and we touched on it earlier around the geopolitical issues. And where Western utilities are undersupplied on material. So ultimately, they're looking to contract it to from safe jurisdictions. The US still has the largest reactor fleet globally. It will soon be surpassed by China, but they are looking for additional supply, ideally from the US, but there's very little to supply to them from the US, and then that leads them into Canada, with friendly nation status. So we think that those projects, particularly with the kind of Canadian, particularly those Canadian assets that are uncontracted and able to participate in the upside that we see in the market going forward, are best placed. So you can see a heavy weighting. We have quite high concentration across our largest positions. So we have the likes of next gen, fission, the likes of ISO Energy, which are well placed, we think, to tie into that and that future contracting cycle. And similarly, we talked on Europe and the issues they've had with losing supply from Niger. They look globally, and there are a limited number of projects with available supply to bring into that. And that's also leading them to look to contract with the North American projects as well.
And elsewhere, I would pick up that we do have exposure not just to Canada, but some of the domestic US operations, which have, I would call it, still small but reasonable production profiles, and are in the process of ramping up into first reproduction, having been former mines. And we do have some operational leverage through slightly higher cost deposits, but we just have to scale that accordingly. For choice, Rob, I think, has just hit the nail on the head in terms of the primary focus.
Right. I think that definitely gives a good idea of your focus, where you see opportunity in the sector. And when it comes to the companies, looking back at this past summer, one of the big pieces of news was Paladin's plan to acquire fission uranium. So curious to know if you think that M&A activity is something that we'll see more of here, given that the pool of uranium companies is relatively small still compared to other sectors.
I'll dive in there first, if I may, Rob. I think undoubtedly it's already the case that it's cheaper to buy and build a risk-adjusted project, and that's in any pretty much mining commodity. And I don't think it will be any different. If not, it will be even more of a requirement, given the challenges in finding ore bodies that are going to help deliver into the deficit that we see. So I would have thought there'll be more. The timing is very difficult to predict, but consolidation is something to watch for.
Yeah, I mean, I'll add a couple of bits. I mean, what are they trying to achieve ultimately by having consolidation? And I don't just mean with Paladin Fission. I mean, we've seen similar with Denison. We've seen similar with Uranium Energy, for example. There's a couple of things. So, firstly, in having scale, I think that helps with regulators. So, particularly if you have a producing asset and you add a development asset, it answers a lot of questions around bringing those projects on, and you also have the team behind that to kind of execute on that. So I think that accelerates that timeline, which in itself is beneficial. As with all mining companies generally, you're seeing kind of a real divergent valuation dependent on market cap, and a few things drive into that, such as index inclusion, ETF involvement, etc., which increases liquidity and often therefore achieves a premium valuation. So, I do think you can see situations where putting two companies together gets a premium valuation through liquidity and brings in some larger funds. One of the issues the sector has had overall is, despite many people really liking the overall story, large generalist fund managers have struggled to find many positions to invest in that provide sufficient liquidity. So in doing that, I think that kind of helps answer some of those questions and potentially brings in some new investors to those companies as we see that. And then there's, the obvious headline of, being able to reduce down your G&A cost in having more assets, less management teams, etc. So, there is clearly logic to it. Obviously, we would always push for kind of synergistic, accretive kind of M&A rather than just growing for the sake of growing. But we can see the clear benefits there. With Fission Paladin, it's more of a producer into developer side, which there is benefits. Clearly, there could have been more sense to kind of having a within the regional group, but it's all dependent on timing and incentives and price, and whether that can ever be achieved between different groups.
Okay, I want to come back to price, which I know we talked about a little bit at the beginning. We spoke about supply demand and the positive fundamentals there, and a little bit about how we came to the price pullback that we're in right now. I think a lot of investors are looking at the market and they're wondering, okay, what's going to happen to the price as we move forward into 2024 and perhaps beyond that. So any takeaways on where the price is going now and into the future that you can share?
I think the bias, it's very difficult to be precise on giving specific price targets for the U308, the conversion and the enrichment aspects to the supply chain. But I'd say the bias is still up. You could quite easily for a period of time see the price more than double and be sustained at that level until perhaps as a result of a mine issue from one of the bigger operations, say Cigar or MacArthur. And it won't really affect the electricity price because, as we said earlier, the key point is that the value of uranium that goes into that supply is a very small fraction of it. So the demand for uranium is very inelastic to price. It's fixed, and it might just be that they have to make good on contracts and go and buy in the spot market as a result, and that will chase the price up. And let's not forget that there are risks associated with concentrated supply that perhaps aren't fully discounted in some of these operators' equity share prices, and I think that's just one of the key facts. I'd say that the risk is still very much upside. And as I outlined at the beginning, don't be put off by the price that we've seen, even some of the volatility. It's a question of pacing your investments, but holding your nerve.
Yeah, I mean, I'll add a little bit to that. I mean, we touched on it earlier. So I think a kind of return of the spot or the carry trade as spots come back more in line with term, I think that really kind of puts a bit of a floor under pricing here. I think as we look forward, if we look to where utility buying comes from, and this is the real question in our sector that always has us kind of scratching our head, but we can look, they've already, through that whole supply chain process, we can see that enrichment and conversion has really increased in price. And that's as they're looking to kind of tighten that. And we know that governments are now looking to fund further enrichment and enrichment expansion, so through subsidies, and we've seen that in the UK and in North America. So there's a real focus on that. And once you have conversion and enrichment capacity, then you look to backfill that with U308 as a Western utility. And as a result, we think they have been under purchasing relative to usage, so they've been depleting their reserves. So we know as a minimum they have to increase their purchasing just to keep flat. And at the same time, we've seen Chinese buy all excess material that's available. So there's a real shortage going forward of Western supplied material to these utilities. So, we are highly constructive on the price. Trying to call the price is very difficult because, unlike other commodities, you don't see any end demand destruction, as Keith touched on, when it's such a low component. So it does feel fairly open-ended, but at the same time, the uranium sector can take a bit longer to play out sometimes than you expect. But ultimately, there is a clear deficit coming, and it certainly points to a stronger price rather than sort of flatlining or certainly weaker.
Right. I think definitely when I listen to experts like both of you lay out the fundamentals for uranium, it definitely seems like I mean, of course, nothing is guaranteed, but it seems like a sector where definitely we're going higher and things will improve. But I do always like to ask, is there a bearish scenario or scenarios that concern you that you have in mind when you look at uranium?
I'd say that if it's specific to uranium, it's harder to find in this sector than in others. I don't think it's going to be so susceptible to a slowdown in demand, but that would still be something that could represent a factor that would influence utilities' timing on purchasing, which is what we're hoping will actually pick up. But I don't think it would completely remove it from the equation. It might just defer it. But that's something that I think would be a more realistic risk. Equally, though, that could be offset by a mine issue because it is so concentrated, or another flare-up in geopolitics. Hidden issues might be a sudden fall in the tenge because Kazatomprom is still it is the OPEC to a bigger degree of the uranium market, and therefore if the tenge weakens, they're more incentivized to increase production to make money as a nation. So that's something that I think is a perhaps less focused on aspect. But I don't think there's too much else. I think it would just be a failure of governments to follow through on policy that has been so unanimously taken up would be the biggest risk. I just think that we're at the very early stages of actually getting a foot down onto that rather than actually lifting off and not following through on it.
So hopefully, so a lot of people would first say key risk is should you have another Fukushima kind of incident, and that's obviously a clear focus. And actually, we like to try and make it clear to our investors that what we saw post Fukushima was a very small decline in ultimate demand. As you saw a relatively small number of reactors taken offline. In Japan, if you look on a global scale, actually what we saw over that period and what led to quite an extended downturn was the massive surge in production we had out of Kazakhstan. And I just kind of want to make that clear as well. So rather than it being purely down to that incident, which was clearly very tragic, but obviously it was more the tsunami that that led to the deaths, etc. With I think was there one or none actually recorded on the reactor itself. So actually it was more down to the surge in the Kazakh production that then led to an oversupplied market rather than the loss of demand from the Japanese reactors per se, because actually the Japanese continue to buy that material on contracts and add it to stockpile. So I think that's just an important thing just to be clear on, particularly now that the Kazakhs have kind of clearly flagged a sort of a reduced growth rate from here, given sort of near-term shortages on sulfuric acid.
Okay, really good to go over that. And I think great context on Fukushima as well. So I think we can wrap it up here, although I'll put it back to both of you before I let you go and just ask if there's any final thoughts that you would leave investors with on uranium at the moment.
I think it's still a sector that's at the early stages of a protracted supply shortfall against a backdrop of firmer demand, and equities still have a considerable room to run against a favourable price outlook for the underlying commodity. And we would obviously like to highlight our fund, which we think, perhaps unlike ETFs, focuses more on the next stage developers that will deliver into this shortfall. And, that would focus in on next gen, as most people that have any interest would see on our website. And those have the better valuations than the premium price to net asset values that are embedded in the existing producers. And for that reason, we think, we've taken an active stance to bias our fund and focus on that side of the investment pool, which is quite small. As I said, we've still got some mix of holdings in the US. To a degree, we've also got some higher cost operations, but the whole sector is still very leveraged to the uranium price in its own right. And I think just a little bit of patience will be worthwhile in a sector which is probably more counter-cyclical than any other commodity market that we look at. So I think there's some defensive qualities to it.
I definitely reiterate that. Be patient. The fundamentals are clear. They just they do take a bit longer to play out, but in the same way, it's not a short cycle. This is a trend and a trade that we believe is going to continue to play out for the next decade, if not longer. So that's the clear benefit from it. But sometimes a bit of patience can be required, because we're kind of reliant on utility buyers who have quite long time cycles in how they operate. So there can be periods where you see less news flow and less price action. So kind of look at the key drivers and then wait for the fundamentals to follow through.
And I think if I could try and differentiate us from other investment opportunities that people watching this will see, it would be that Rob's a very experienced geologist. I read physics for what that's worth. I wouldn't read too much into it, but how things work in this sector. As a result, we've met and we've been running this fund now, I think, for one of the longest periods of time that we've been able to find. Certainly I've looked at this sector for well over a decade, and Rob similarly, and we've met under various guises most of the assets that come around circulating around conferences such as the WNA symposium over here in London. And I think we've got through that a very broad knowledge that is something that we feel we can run actively and add value through.
Okay, very good. Thank you so much for coming on to talk about what's going on in uranium and about the fund. This was really informative for me. Really good to have you here.
Thank you very much indeed for having us.
Thank you.
Of course. And once again, I'm Charlotte McLeod with investingnews.com, and this is Keith Watson and Rob Crayfourd. Thank you for watching. If you like this video, make sure you hit the like button and subscribe to our channel. We'd also love to hear your thoughts, so leave us a comment below.